Hello, folks, and welcome to today's episode of the Hospitable Hosts podcast. Today, we're talking to Jeff Cottle from Anderson Business Advisors. Jeff's going to lead us through some of the top tax season FAQs for the US. And so hang tight. We're going to get straight into it now. And as always, if you like today's episode, don't forget to like and share. Thanks. Hey, Jeff, welcome. Thanks so much for joining me today.
Thank you for having me, Miles. It's a pleasure to be here.
Sweet. So before we get started, I want to kind of chat about very briefly, what are some of the common things that, Anderson basically deal with in terms of short-term rental tax for property owners and property managers?
Yeah, absolutely. So I think that's a great thing to start with, Miles. And to be sure, we're really, really happy to be here. We work with short-term rental hosts, whether they're property owners themselves or whether they're just managing short-term rental properties all over the country. And we love doing this. It's a fun, interesting, and cool industry that has popped up a lot more recently, especially with technology, making booking and marketing and all of these things so much easier. So we love working in this sphere and in this sector. And I think it's a really great idea to just start with, hey, so what are some of the basic things that we talk about with everybody? And then we'll kind of jump into those more frequently asked questions. So when I'm interacting with a client, whether they are whether they are a business owner or a real estate investor or a host, a property manager, whatever else it might be, the very first thing that I tell them is, hey, let's make sure we are not doing things in your own name. And here's what I mean by that. When we talk about saying, okay, I am a property owner, or I am a business owner, or I am a property manager, whatever it might be, we want to make sure that at a very basic level, you have a business entity of some sort in place. Why do we do that? There are a few reasons, but the number one thing is it separates yourself from the business. This may not be everybody, but I'm going to use this because it's a really straightforward example here. If you own a piece of real estate, or if I own a piece of real estate, say in my own name, say I have a property that's on 123 Main Street, and I say, okay, Jeff Cottle owns 123 Main Street. Then if I have a slip and fall, somebody injures themselves on the property, whether it's a real injury or not, right? The first thing that's going to happen is this person who gets hurt, they're going to go to an attorney, and the attorney's first question is not, do you have any bills? It's not, have you missed work? It's not, what kind of injuries do you have? It's, who owns the property? Why? Because they are deciding whether it's worth it to sue in the first place or not. And if they see that Jeff Cottle owns the property on the public records, and then they can look up online and do some snooping, and they'll see Jeff Cottle actually owns 5, 6, 7 other properties, they're suing. No matter what. Yeah. Like, it doesn't have any sort of analysis of what the potential payout it is or not. If they can see you're a good target, that it doesn't matter what's going to happen.
Okay.
And so what we do then is we say, okay, at the very least, let's put this property into an LLC. LLC stands for Limited Liability Company. Registered with your local state, the limited liability company literally, as the name implies, we get really creative with these names, limits your liability so that if something happens related to the property, it doesn't impact you. Same scenario now, slip and fall on the property, but the owner of the property is the 123 Main Street LLC. Plaintiff's attorney now knows, well, one, he's not going to find any of the other properties because he doesn't know who owns it. But two, he or she, pardon, but two is that the liability is limited to just that one property. Can't touch me, the human, can't touch any of the other investments that we have. And this also applies to managers and to hosts and business owners as well. Same thing applies if I have a pizza parlor. Right? If I have a pizza parlor and it's owned by me personally, anything that goes wrong, say we have an outbreak, food poisoning or something like that, well, that comes to me personally. We have an LLC or a corporation, as the case may be, boom, limits that liability. Same thing if you're a property manager. We want you to have your own company to make sure you limit that liability. Property managers especially, unfortunately, have really big targets on their back because it's really easy for somebody to have a slip and fall and for them to say, that was the manager's responsibility. They should have done something about this. And so that's going to be a very basic tenet or principle that we talk about today is, hey, let's invest, let's own our businesses, let's manage our properties through a business entity. Gives us protection, and very importantly, on top of that protection, allows us to do some tax planning as well. And with short-term rentals, tax planning, we can have some fun with tax planning. We can really get there with that. So wanted to cover some of that basic information. So you'll hear me talk about limited liability companies, all right, separate business entities. You'll hear me talk about corporations, also separate business entities. Corporations, the big difference for them is going to be more of the taxation that we can do, or a corporate tax status. Sometimes LLCs can even be taxed as corporations. That gets fun. But so as we talk today, you'll hear me talk about those different things. And so this is why. That's the sort of the baseline knowledge is, hey, let's use business entities. Now, how we arrange them, what kinds we use, what we're going to do with them, all of that we'll talk about here in a little more detail. And it will vary depending on your specific situation. But that's going to be the baseline. Let's start with those. Does that all sound okay and make sense there, Miles?
Yeah, that definitely makes sense. And I think the biggest thing to unpack there out of that is probably, the first question being, what is the best business structure? How do we choose between LLC and corporation? And I know it's a big question to unpack, but what are some of the general things that we should be thinking about that?
Yeah, absolutely. So I know this is just so bad because it's the attorney cop-out, right? The it depends. Sorry, but it depends really applies here. If you ever want to get a question right in law school, just say, it depends, professor. That's the right answer. But what we're going with here is, at the very least, I'm going to talk about a couple of general scenarios, but then I'll dive into some specific examples. These won't apply, the examples won't apply to everyone, but it'll illustrate some of these principles here. So first, some of the basic levels are, if you own a piece of real estate, our first and primary recommendation will be, let's put that piece of real estate into an LLC. Almost always. Sometimes we'll recommend a land trust. For example, if the property is encumbered and your lender has been breathing down your neck, we might use a land trust instead. But we're going to start with an LLC. You own the property in an LLC. That LLC will more than likely either be disregarded tax-wise, meaning it doesn't file any taxes, which is really nice because it doesn't add to your tax return burden at the end of the tax year or the beginning of the following year. Or it will be taxed as a partnership. And we want that because it allows all the taxation to flow through to you. In this case, as a property owner, that's a good thing. We don't want to impact the taxes necessarily as a property owner right now. We like leaving those taxes as they are when you own real estate. Though again, we can play tax games outside of it. For now, we like disregarded or partnership LLCs for property ownership. So that's one general principle. Second general principle is, if you are managing property or you have another active business, managing short-term rentals is considered active. Owning a short-term rental, if it's 7 days or less, can also be considered an active business. We can talk about that in a minute. But if we do have an active business, we're going to have a corporation involved there of some sort. So using another basic example, let's say you are managing properties that are owned by somebody else. You're a short-term rental property manager. You don't have any of your own properties yet. That's totally fine. No worries there. I will say, hey, let's use a corporation. If this is your primary source of income, we may use an entity taxed as an S corporation, because the IRS incentivizes you to take money out through some of the provisions they give to an S corporation. So if it's your primary source of income and you're taking money out anyways just to pay for groceries and ordinary expenses, we use an S corporation. You get tax benefits. If this is not your primary source of income and it's more of a side hustle, we may recommend a C corporation instead. It has more deductions allowed to it, and you're not forced to take out the money in order to get tax benefits. So the C corporation is better if you're not taking money out to pay for everyday expenses. So those are a couple of general principles. And as you can imagine, if you are both managing your own properties and other people's properties, we may have a mix of both, right? We may have an LLC for each of your properties. We may have another corporation to host all of your management activities. And we may even have a parent company underneath. If you've seen some of our videos here from our partners, Clint Coons and Toby Mathis, they talk a lot about having a parent company in a state that has good protection, like Wyoming or Delaware, to provide some additional protection from lawsuit there. So those are a couple of the general principles. Does that sound okay, Miles, there?
Yeah, that makes sense.
Awesome. So let's dive into one specific example here. I don't want to get too far into the weeds, but I think this is a good one to show what we're talking about. let's say here that I have my broker's license, and so I'm managing other properties as well as my own. And this is my primary source of income, so I'm doing it through an LLC, taxes, and S corporation. Awesome. We're looking good. What I may have then is I may have, let's say, 3 properties that I own here. There are a couple of vacation spots near where I live in the middle of nowhere near some lakes. And so let's say I have 3 properties out there, and they're all owned by their own individual LLCs. And those LLCs are owned by a parent company down here.
Yeah.
So I say down here, for those of you in the podcast, I just be aware I'm waving my arms everywhere like a crazy man. But what we talk about then is we may say, okay, we have all of the income flowing through to the S corporation. And that might include the income from your own properties flowing through into the S corporation. So you collect all of it because you're a property manager. That's what you do. So we have all of the income flow through into the S corporation, and we have property management agreements with each property or property owner that you work with. And yes, again, that includes your own properties. If you come work with us at Anderson, we help you put together all of those agreements. So your own property owning LLCs will have property management agreements with your management company. And then the management company collects all the fees. Importantly, it pays for all of the expenses out of the management company. This can make bank accounts a lot easier. And then after that, like a good property manager, it reimburses or sends out whatever money is left over to the respective property owners, again, including your own individual LLCs. This is a great way to arrange it. It makes things easier logistically. We funnel as much income as we can into that corporation for the tax benefits, and then you get to sit and have this really nice arrangement that gives you tax benefits, gives you what we call anonymity, meaning people don't know that you own the properties or own the business, and gives you protection from lawsuit. So that's a moderately advanced structure there, but it kind of gives you an idea of what we might look like for some of your individual situations. Again, each one will be different, but that's a good illustration of some of the principles that we're talking about there. When somebody asks me, getting back to the original question, well, what's the best arrangement? It may look something like that, like we were just talking about.
That makes sense. Okay, that's good to know. And so that's kind of interesting to kind of learn about the structure of the entity and I guess the limited liability elements. What about tax deductions? And you kind of touched on it before, but what are some of the ways that STR owners can legally maximize their tax deductions? And I know there's a few different ways.
Yeah, and you're exactly right. There are a few different ways that it can happen here. And so when we talk about how we're managing or maximizing our deductions, I hope you'll forgive me. It came up again. It depends. I'm sorry. But here's what I mean there, is it will depend on what your objective is. So let's use this as a similar example, but something that's slightly different. Now let's say we have the same principle, 3 properties, managing your own properties and a few others through a corporation. But now let's say this is sort of a side hustle. This is not your primary source of income. You or your spouse has a day job, and you're not worried as much about providing for your family or paying for your expenses, whatever else it might be, through this setup. So now we have a C corporation instead of an S corporation managing the property. The ownership setup with the individual LLCs for each property will be about the same. What we're looking at here is, very importantly, this is a great way to maximize our taxes. I mentioned earlier, hey, we want to funnel as much money into the corporation as we can. Why do we do that? Because the corporation, both C and S corporations, but especially C corporation, has literally, they just have more deductions allowed to them than do ordinary LLCs. And so I'll give you an example. If we're using a C corporation, the C corporation can actually pay for your healthcare expenses tax-free as a deduction. And so what happens, the way it works actually is you reimburse yourself. So I'll give you an example here. Let's say you head to the emergency room, you or a dependent of somebody has a broken ankle, and it costs you a few $1,000s to go to the emergency room, get a cast on, get everything worked on, all of that. It might even cost more depending on the situation. And so just to use a round number, let's say $10,000 to get all that done. What happens is if you have $100,000 of income in that C corporation, well, you can reimburse yourself that $10,000 tax-free. So what happens is you pay $10,000 to the hospital, corporation reimburses you for that $10,000. You don't pay any taxes on it because it's a reimbursement. It's not income. And then now suddenly you only have $90,000 to pay taxes on instead of the full 100. All right. So you've just reduced your taxable income without actually giving up a penny. So that's the kind of thing that we look at. And it's not just healthcare. Education expenses can come out of a corporation. Some of you may have heard of the home office deduction or reimbursement. We like the home office reimbursement better, though that's being really pedantic because most of you, I don't expect you to know the difference not being attorneys. But also there, we can talk about the home rental, right, where you rent out your home to your business. All of those kind of things are the same idea, where you reimburse yourself for expenses. Again, reimbursing, so it's tax-free. That's not income. And then you lower your taxable income, so you pay less in taxes, but you're actually still keeping all of that money. So those are the principles that we're getting at there using a corporation. Is you just get more expenses. Now I'm going to talk about another benefit of the corporation, then I'm going to adjust a little bit more, or give one more example. So again, using the same thing, the side hustle scenario here, the other thing that the corporation does is it can actually allow you to change the nature of your income there. So if you're paying into a corporation, that's active income because the corporation is managing the properties. It's earning the money. Sometimes we call it earned income. Earned income, active income, they're functionally the same thing. But then what happens is really nice is if your corporation is then paying out money to each of your individual LLCs after it's accounted for all of the expenses, this earned and active income can actually, if you use a special lease agreement between your corporation and your property owning LLCs, it can actually change your active income into passive income. Why does that matter? Well, because passive income is taxed less. It's not subject to Social Security and your other sort of ordinary payroll and withholdings. And so if you were doing short-term rentals 7 days or less directly in the ordinary LLCs, or even better, if you're just doing it in your personal name, then it would be subject to payroll, withholdings, all of those other things. However, or sometimes the self-employment taxes, right? Sometimes what we call them. However, if you funnel it through a corporation first, we can remove those withholdings from the income and then just pay it out to your LLCs as if it were passive income, which it is. And then you save taxes on that too. Frequently, it's going to be in the neighborhood of 15% that you're saving by funneling the income through the corporation and paying it out that way. So that's another way to get some tax savings there too on the income that your short-term rentals produce, if you have your own. Now, if you don't have your own short-term rentals, again, that's awesome. I still would absolutely recommend using the corporation to get those additional deductions, right? That's a great way to go there. And so those are some things that we can use, and some of the again, I say games. This is all perfectly legal. We're not hiding anything from the IRS from that perspective. Like, no, we've defended these strategies for the IRS. That's why we still use them. So these are some of the strategies and things that we can engage in here. I'll touch on one more scenario. I won't go super far into the weeds in this one, but this is sort of a common sub question that we get, is saying, okay, now I've heard of using a short-term rental to offset my W-2 income. Some people who are high W-2 earners will say like, hey, I've heard that a short-term rental can offset my taxes there. The answer is yes, it can. And we may not be using a management company in that scenario because the IRS wants to know that it is you personally, the human, managing the property. So you may just have these 3 LLCs, again, using our same example scenario, no more corporation up here in the corner, just kind of erase that. And you are managing the properties yourself. What happens then is we'll go ahead and say, as the property manager, if, and this is where the key comes in, if you have losses in those properties rather than gains, and you are managing those properties personally, then you can take those losses and offset them against your W-2 income. Now, there are a few rules that we have to follow. The most important being that we have to prove to the IRS that we are actually managing the property, not just pretending we are, wink, wink, and then you're paying somebody else, right? The IRS has some pretty specific rules there about, hey, what counts as the term we use is material participation is the legalese term that nobody likes, that some of you may have heard before. So what counts as material participation is a whole other conversation, but basically the idea is you have to materially participate. You actually have to do work on the property. Then the second part, of course, is we have to drum up a loss, right? So you materially participate on the property and you have to lose money somehow, whether that's because you actually spend money in repairs and it's more money that you earn, or whether you do something else to create a paper loss. This is where a cost segregation study might come in. So that way, if you use a cost segregation study just as an example to create a loss, and you are personally involved in the day-to-day management of the property, then awesome. We can take those losses and use them to do exactly what we were talking about before, to take your income that you would have, let's call it $500,000, and offset it against the losses that you have, whether that's 10 or 50 or $200,000, whatever it is, so that you still keep all the income, but you have, because of your short-term rental property, reduce the actual taxable income on that amount. So those are some of the tax strategies and things like that we can talk about, and then we absolutely do talk about with some of our short-term rental owners and managers there.
Awesome. Thank you for that thorough run through, Jeff. Cool. So just kind of moving on from some of those deduction strategies, though. So we definitely have a lot of hosts that are, managing properties across different states, or maybe thinking about doing that, thinking about managing remotely. Maybe they've got one place in the state of California and they've seen a cool place in Colorado they'd love to host. What are some of the things that folks should be thinking about there and the differences by states?
Yeah, that's a great question. And the short answer is going to sound really reductive, but it's true, is that you need to be aware of the rules of each state and even of each locality. And you say, well, no kidding, Jeff, but here's what I'm talking about specifically. So first is we need to make sure, if you're using a business entity, we need to make sure that you're properly registered in each state. And very frequently, it's just a matter of, okay, we are going to have to use what we call a foreign filing. Let's say that you do. Let's say you live in Anderson's home state here in Nevada, but you're managing properties, like you said, in Colorado or maybe in Massachusetts or Vermont. I don't know. Another popular investing state right now is Texas or Florida, or even a couple in the Midwest like Nebraska. But anyways, point being, you've got states all over the country. We need to take your management company and foreign file it in each state in order to do business there. And I would just add a sort of a side note there. Every time we foreign file an LLC or a corporation to a different state, we're adding just a little bit of liability to it. So I just say, make sure we don't keep many assets in your management company. Continue paying yourself regularly, reinvesting the money elsewhere, so that if something does go wrong with the property management, well, they can look at your management company, but you don't have any assets in it, or very little at least. And so, again, it cuts off that liability. All of your other investments or activities are protected that way. So the first thing is going to be making sure properly registered in each state where you have properties. The second thing is checking, especially for short-term rentals, the local rules for short-term rentals. Now, I know a bunch of you probably have already run into this, but this is something that's popping up all over the country, that localities, so counties, cities, municipalities, townships, whoever it is they are cracking down on short-term rentals, not necessarily making them outright illegal. Here again in Nevada, Clark County tried to make them illegal. You can imagine how that went. but more that they're trying to make it more difficult, or at the very least more regulated about short-term rentals. And people ask me all the time, well, okay, but how do I get around these regulations? And the answer is that there's no magic wand. And here's what I mean by that, is that these rules and regulations are put into place by, municipalities, by cities, by counties. They're all run by human beings. And very frequently, they're put into place, and these humans that are making these regulations, they don't know. They don't know how they're going to enforce them. They don't know how they're going to actually make sure this regulation is followed. They don't know the details of how it's going to be implemented at all. They just kind of make the rule and kind of realize like, wait, I'm the one that's supposed to do this, huh? Wow, weird. And so being run by humans means that we deal with the human factor almost just as much as we are dealing with the legal factor in these local areas, right? And so when somebody asks me, how do I get around these rules? I say, well, first, know what they are, right? And second is that we'll have to take a look at each one, but the answer might legitimately be, sorry, you have to make sure they're followed. Sometimes that's just the case. There's not going to be magic wand for every scenario. Now, there are some times, again, I'll just use Clark County in Nevada because it's obviously a very popular one that we know about. Sometimes there are ways that we maybe not necessarily get around them, but we make it the burden a lot less, right? We say, hey, if you try this, we've seen this work, whatever. But we're not going to have that for every single city and every single county. And again, they probably don't even have it for themselves, right? And so that's going to be a big factor of what we look at. Is just like, hey, make sure you know your area when you're managing the property. Make sure that you know the localities, the customs, the things that they're looking at, so that you can be prepared. And importantly, the type of guests that are going to be staying at your property too. All of that's going to matter a lot. And so again, I realize it's reductive. I realize that that's, not really a cool secret knock on the door password answer kind of thing. But honestly, so many of our issues that we run into would be avoided if people took the time to do that. If our short-term rental owners and managers took the time to research each area in detail and get to know what's going on there.
Yeah, that makes a lot of sense. And so that kind of leads me on to my next question, because I want to kind of talk a bit about, pitfalls and I guess mistakes people make. So I want to kind of understand what are some of the, top legal pitfalls that you see short-term rental hosts make in terms of kind of maintaining compliance, which you kind of touched on there, and also protecting investments, which I know you also touched on a bit earlier too.
Yeah, absolutely. So this is going to sound a little self-serving, but I mean it genuinely when I say the top mistake that I see is people trying to set it up themselves, even if I'm not even talking about just Anderson, but speaking broadly, right? Without, at the very least, consulting with an experienced investor or an attorney or a CPA that is familiar with this industry. And you say, okay, so that's very broad, Jeff. What are some specific examples of what you mean? So I talk about, for example, just now I talked about using corporations, right, to do management. Some people will take that and they'll say, okay, cool. So I'm going to make a corporation and buy all of my properties with a corporation. And I say, well, actually, no, that's not a good idea. There's a reason I talked about a corporation for management, but not owning the properties, right? Or they may say, hey, my accountant charges $1,000 to set up an LLC, or Anderson, we charge $1,800 because we add in a bunch of documents on top of that as well. But LegalZoom, pardon, they charge $400 or $500 to set up an LLC. I'm just going to pay them to do it instead. But the big key is, can LegalZoom set up an LLC for you? The answer is yes. I'd be lying if I said no, right? Of course they can. But LegalZoom doesn't consult with you about what you're doing with the property. LegalZoom doesn't give you an operating agreement. LegalZoom doesn't help you with resolutions. LegalZoom doesn't help you with knowing what kind of tax status you need. None of those things. And so when I see, people who have sort of done DIY, it's not that they don't have an LLC or that they don't have a trust, but the one that they do have is either not actually helping at all, or it's not appropriate for their situation, or honestly, very frequently, it's doing more harm than good. And that's just because, you're not, you as an investor, no, you're not an attorney. And I wouldn't expect you to be sure. I don't expect you to know all of these things. But it's very important to talk with people who do. And funny, really quick anecdote, this is a real story, but my wife is also an attorney, and she was doing her time as a clerk with some judges, and one of her judges had a case before them that was about two business owners who did exactly this. They decided, we don't want to spend a ton of money on attorneys. We're going to make our own contract ourselves. And in the contract, they said if there was ever a dispute, it was a food truck, and if there was ever a dispute about the truck, the person who guessed the coin flip correctly at the next Super Bowl got to either keep the truck or decide what happens. You can see where I'm going with this. There was a dispute. Somebody did guess the coin flip correctly, and the other partner immediately filed a lawsuit. The truck was worth that much. And so then they were spending way more on attorneys arguing over it in court than they would have if they had hired somebody to help them out and putting it together in the first place. So again, it doesn't even have to be Anderson, but talk with someone. I know you're going to say, like, Jeff, well, we won't put a coin flip in our contract, sure. But just trust me when I say I see stuff like that all the time. And so, again, even if it's not Anderson, but talk with a professional, talk with somebody who knows what they're doing, because these kind of things, you want to be pretty exact in how we put them into place. If not, it creates a lot more trouble down the road.
Yeah, that makes a lot of sense. And like said in some of your answers, it depends, right? There's no
Always
one
will.
size fits all, So you really need to look at your specific situation. And if you don't know all of this stuff, it's better to have an expert look at it and help you out with it, obviously.
Yeah,
And
absolutely.
just a last question before we kind of get to the end of wrapping up here, Jeff. What is the role of kind of estate planning in safeguarding short-term rental investments for like future generations, basically?
Yeah, that's a great question. I love talking about estate planning too. So just speaking broadly, so we're again operating from the same definition here. Estate planning is when we talk about, what happens with your stuff, your assets after you pass away. And so this is where, yes, a last will and testament comes in, or a living trust. We will always recommend a living trust here at Anderson. The reason for that is because the living trust is how you avoid probate. Probate is the process by which a judge and a bunch of attorneys determine what happens to your assets after you pass away. If that sounds awful, it is. So you're right. But what we will do then is we say, okay, in order to avoid the judges and the attorneys leaving it up to them to decide who gets how much and leaving it up to them and then having to pay them for it, good night. What we say instead is use a living trust. So put your property management business, put your properties, put whatever other assets you have into a living trust. So then you control what happens. And then your heirs, your children, family members, friends, whoever it may be that you designate to receive your inheritance after you pass away, they don't have to go through a judge. They don't have to hire attorneys. They don't have to go through that awfulness. They can just instead execute what you have determined in your living trust. And that control is very important because just as much as it is awful to have a judge determines what happens to your assets and paying them for it too, it's also just as important for you to say what happens. Because if the judge is in charge of it, it opens up the door for your heirs or your beneficiaries or even people who are not your heirs to jump in and fight over all your stuff. So if you have a successful management business or if you have a bunch of properties, then not only are you paying a bunch of different judges, because especially if you have properties in other states, oh man, trying to get two probate judges in different states to agree on which law of which state has to apply for which asset and when, it takes years and so much in attorney fees that your estate pays for. But then on top of that, it opens up your heirs to fight amongst each other. I had our friend, our head estate attorney here at Anderson, he tells the story that the biggest fight he ever saw over assets was over a sentimental cookie jar from the deceased's home. And there's a fight among the children and relationships were legit ruined over this. And so you prevent that when you have an estate plan into place. And so what we do then is we take these structures that we've talked about today and we can help make sure that they all flow nice and neat into a living trust so that it's basically, use the Christmas time theme, it's basically wrapped up, packaged with tying a bow on top for your heirs and your beneficiaries after you pass away so that they're not inheriting a mess. They're not inheriting work. They're not inheriting a fight. Oh, heaven forbid. They're inheriting income for themselves and their future generations that they then receive with grace and happiness, and importantly, with remembering you and your legacy. So that's the role is we'll put it all in a nice, neat bow, put it all into the living trust so that it makes sure then that it continues after you personally.
That makes sense. Cool. Awesome. So thank you so much, Jeff. Well, obviously there's a lot to unpack. You've just scratched the surface, obviously. So we're going to drop some links into the episode description. What are some of the ways, kind of next steps that folks can find out more and maybe just start thinking about this kind of stuff in a bit more detail?
Yeah, absolutely. So we would love to come work with you, and I hope you'll forgive me as I pull up the link here myself. But we would love to have you come meet here with us at Anderson Advisors. So you'll see we have an event. We call them our tax and asset protection events. And we'll give you access to that. So you see that in the link where myself and our partners, so some of you may be familiar with Clint Coons and Toby Mathis, we go in and we talk about a lot of these different strategies and a lot of the different things that you can watch out for. We tell funny stories. We tell scary stories sometimes. We try to lean more towards the, the happy, good stuff. But we'll talk about all of these things in a lot more detail. It's almost like an education class that you don't have to pay for, very importantly, though. Because most attorneys, they hide behind these just wild hourly rates. Like my hourly rate, more than $500 an hour normally. Now, fortunately, I don't have to pay or don't have to charge that, pardon, very much anymore working with Anderson. But that's the kind of thing where instead, though, we're just giving out this information. And so you'll see a link to come and join us at one of our tax and asset protection events. And you get awesome discounts on our services when you go there too. And so if you want to join us from there, we'd love to see you and love to work with you. And they'll talk about all of that we've talked about, a lot more about us here at Anderson and what we do in detail at that event.
Sweet. Sounds good. I appreciate you sharing that.
Thank you as well. It's been a pleasure to be here, Miles. Is there anything else that maybe we haven't touched on that you feel like we ought to cover before we take off today?
I don't think so, but I'm sure that any of our listeners, if there's anything that we've missed, please do let us know in the social media comments and the podcast comments, and I'm sure that we can get Jeff back to answer off some of the questions that we've missed, if there is anything.
Yes. I love to be back. Always love interacting and answering questions. So thank you again, Miles. It's a pleasure to be here and wonderful to chat with all of you as well.
Thank you very much, Jeff. See you soon.
Take care.
Thank you so much for listening to mine and Jeff's conversation today. If you enjoyed today's episode, please don't forget to like and share the podcast. It's really appreciated. Thanks for listening.